was up against an unusually strong prior year comp following the launch of a new product slate and boosted by COVID tailwinds. As a testament to the increasing depth and breadth of our network, no single merchant accounted for more than 10% of Q2 GMV. 1 year ago, we discussed how we would expand into higher frequency purchase areas and diversify our merchant partnerships. A year later, I'm really proud of how our team has delivered on these objectives for our shareholders. Shifting to industry verticals, we had a phenomenal holiday season. We more than doubled our volume for Black Friday, Cyber Monday, and we believe we took significant market share from both traditional incumbents and BNPL pure plays. As Max shared, we estimate that Affirm facilitated 1.6% of total online transaction volume for the Black Friday, Cyber Monday period in the US, and we saw particular strength in key holiday categories in Q2. Travel and ticketing increased up 314% from last year, topping last quarter's high mark, even despite the emergence of the Omicron variant. General merchandise grew 368% above last year, driven by our deepening partnership with the industry's leading retailers and the launch of our offering at Amazon in the US. Consumer electronics, which grew 209% year to year, was another great story driven by strong demand for TVs, laptops, and gaming consoles. Our results this holiday season highlight our ability to take share and grow in any environment, and importantly, why we're so different from the competition. Outside the US, we had another outstanding quarter. Our Canadian business more than tripled in size, thanks to existing and new partnerships, including Apple, which launched in the fall to brisk consumer demand. In the second quarter, we also entered the Australian market with Peloton and look forward to growing our business with them there. This quarter, our interest-bearing program, which includes our initial offering at Amazon, grew significantly, up 124% year-on-year to $1.4 billion. Before I jump into the financials, let me walk through the mechanics of this offering to illustrate the impact on the income statement. On the revenue side, we monetize these loans by either holding them to maturity or selling them to third parties. When we hold the loans, we primarily earn interest income, which we recognize over the duration of the loan. Hence, this quarter's revenue reflects just a portion of the total yield we will ultimately see from the GMV we generated in Q2. We will recognize the balance over the subsequent quarters. As an illustrative data point, we sold 59% of the interest-bearing loans generated in the US this quarter and retained the remainder. On the expense side, we provision for credit losses up front. For loans we hold, this means that the margin profile is back-end weighted. Our partnerships with key enterprise merchants are unlocking more opportunities for our business every day, and we are investing today to realize the full long-term potential. While we are just in the beginning stages in scaling these partnerships, we are already seeing them drive network expansion, and we expect to deliver strong unit economics when they reach scale. Now, turning to the financials. The strong GMV growth also drove strong revenue growth. Net revenue grew 77% to $361 million, well above our outlook. Total network revenue grew 39%, while interest income increased 87%, and gain on loan sale rose fourfold. Revenue as a percentage of GMV contracted 170 basis points to 8%, driven by product mix. Split pay grew over 4 times year-on-year and accounted for more than 20% of GMV in the second quarter from just 11% last year. In our earnings supplement posted to our investor relations website, you will see that merchant revenue take rates have remained relatively constant for each of our offerings. On the expense side, we continue to grow revenue faster than transaction costs, delivering real leverage. Total transaction costs of $177 million grew 63% year-over-year compared to revenue growth of 77%. And excluding provision for credit losses, transaction costs as a percentage of GMV declined 190 basis points to 2.8%. Given the mix shift from longer duration 0% APR loans, loss on loan purchase commitments declined 4%, while improvements in our capital program helped limit the growth of funding costs to 47%. Provision for credit losses grew from $13 million 1 year ago to $53 million, as the year-ago figure included a $39 million release of excess COVID-related loan allowance, while this year's figure reflects the intentional normalization of credit that we've discussed over the past several quarters. Over the first half of the fiscal year, we have managed delinquencies of 30 days or more to remain below the same periods of fiscal 2019 and 2020, even as we have expanded the credit box to a more normalized level compared to the early days of the pandemic. Our strong top-line growth and leverage we achieved on transaction costs drove a 93% increase in revenue less transaction costs to $184 million, above our outlook range, or 4.1% of GMV. Looking at OpEx beyond transaction costs, we continue to invest in building our team and elevating our brand. We doubled headcount to more than 2,000 affirmers and increased marketing around the holidays. Our teams have delivered a torrent of exciting new offerings, while our brand campaign drove greater awareness across all age cohorts and helped us reach the highest aided awareness among BNPL providers at 45%. Growing our team resulted in higher personnel costs and stock-based compensation. In Q2, total operating expenses, exclusive of transaction costs, grew $258 million, of which $158 million was related to D&A, stock-based compensation, warrant expense, and one-time expenses related to our IPO and acquisitions. Excluding these items, non-transactional operating expenses grew 109%. On a GAAP basis, operating loss was $196 million, which compares to a loss of $27 million last year. Adjusted operating loss was $8 million in the quarter compared to a $3 million of income in the prior year. Now turning to our balance sheet. We fortified our cash position and delivered accelerating GMV growth while continuing to manage our capital with discipline and efficiency. In November, we issued $1.7 billion in zero-coupon senior convertible notes with a 5-year maturity, which has significantly increased the capital we have to invest in growth at an extremely attractive long-term borrowing cost while minimizing dilution. Our effective capital markets program and disciplined approach helped reduce equity capital used to fund our business from $277 million last year to $230 million, even as loans on the balance sheet grew by more than $500 million. As a percentage of total platform portfolio, equity capital required declined to 3.6% from 7.5% last year. Total platform portfolio grew 72% from $3.7 billion to $6.3 billion at the end of Q2, and we increased our overall funding capacity in line from $4.7 billion last year to $8.8 billion. Over the past year, we brought on $1.9 billion in new loan buyer commitments from both new and existing capital partners. Our balances held by third-party loan buyers from our forward flow program grew 129% to $3.7 billion, while our securitization program grew 83%. Our warehouse balances declined 24% as we continue to focus on more efficient funding vehicles. Before I move to our outlook, I want to touch on an important topic that has been top of mind for investors: interest rates. While potential interest rate hikes have dominated headlines, we remain confident in our ability to continue to grow rapidly while delivering strong economics as rates rise. Our financial outlook already reflects the roughly 180 basis point increase embedded in the 3-month LIBOR forward curve, and our current long-term model, which calls for revenue less transaction costs of 3 to 4%, also assumes rate normalization. We have significant advantages to help us mitigate the impact of rising rates, including broad and diverse funding partnerships that allow us to shift funding to less rate-sensitive counterparties, sophisticated underwriting and risk management infrastructure that allows us to manage unit economics with changes to our cost environment, and high turnover, short-term assets that make our portfolio inherently nimble and able to react quickly to changing market conditions. At a constant product and funding mix, we estimate that a 100 basis point increase beyond the increase implied by the current yield curve would only result in a 10 to 20 basis point impact to revenue less transaction costs as a percentage of GMV for the remainder of fiscal year 22. Looking out to fiscal 23, we believe that a further 100 basis point rate increase, again beyond current expectations, would only result in approximately 20 basis point impact to revenue less transaction costs as a percentage of GMV based upon our current funding and GMV mix. And that is before we apply any of the numerous offsets we have, including consumer and merchant pricing, funding strategies, and credit optimizations. Looking beyond fiscal year 23, at our current funding and product mix, we estimate the impact to revenue less transaction costs as a percentage of GMV to be approximately 40 basis points for every 100 basis points of rate movement beyond the current forward curve. And again, that is before applying any cost, credit, and revenue optimizations. Now, turning to the outlook. Our business has never been stronger, and as we look to the remainder of our fiscal year, we are raising our financial outlook to reflect the robust second quarter results, accelerating momentum in the business, and we are now including Amazon's expected contribution to the outlook. For fiscal year 22, we now expect GMV to be between 14.58 and 14.78 billion, representing a 76 to 78% increase from fiscal year 21. Given the strong traction we are seeing with Shopify, we now expect our split pay offering to comprise 15 to 20% of total GMV for the fiscal year. We expect revenue of 1.29 to 1.31 billion, representing year-over-year growth of 48 to 50%. We expect transaction costs of 705 to 715 million, resulting in revenue less transaction costs of 585 to 595 million dollars. This reflects the continued mix shift we are seeing in the business. We expect an adjusted operating loss as a percentage of total revenue of 12 to 14% as we continue to invest in the long-term growth of our business, and weighted average shares of approximately 285 million. Consistent with Max's remarks, our outlook does not assume a material impact from the rollout of Debit+. We also expect a very strong fiscal third quarter with GMV of 3.61 to 3.71 billion, total revenue of 325 to 335 million, transaction costs of 187 to 192 million, and revenue less transaction costs of 138 to 143 million. Adjusted operating loss as a percentage of revenue of 19 to 21%, and weighted average shares outstanding of 290 million. In closing, we just posted an incredible quarter of growth, and our team is seizing this momentum to continue to deliver on our mission. I'd like to add my thanks to the great work of all Affirmers this quarter. Max and I will now open the line for questions.
Thank you. Ladies and gentlemen, at this time, we will be conducting a question and answer session. If you'd like to ask a question, you may press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. One moment while we poll for questions.
Before we open it up for Q&A, I want to briefly address the earlier than customary issuance of our earnings press release today. Due to human error, a small portion of our Q2 results were inadvertently tweeted from Affirm's official Twitter account earlier today. And because of that, we felt it was appropriate to release our full financial results as promptly as possible thereafter, rather than waiting until after the market closed. With that, I'll turn it over to Doug to begin the Q&A session.
Thank you. Our first question comes from the line of James Faucette with Morgan Stanley. Please proceed with your question.
Great. Thank you very much. I guess my first question is, obviously, the December quarter was massive for you guys, but the outlook doesn't seem as comparatively strong, especially the March quarter, and particularly if we're now incorporating more split pay from Shopify and Amazon, et cetera. Can you walk us through kind of that dynamic, especially on a sequential basis? I mean, is this seasonality, more than expected drag from Peloton, impact of revenue timing on Amazon and others? Just kind of help us understand the sequential evolution of the business.
Yeah, I'll grab that one. And I think to start off, we're very happy with the pace of scaling in the network. The Q4 results, as you said, were pretty spectacular. Sorry, calendar Q4 results were pretty spectacular, and it was indeed a special quarter. We are reiterating our guidance and taking it up, and so our outlook continues to improve for the balance of the fiscal year, and we're still well in excess of the growth phase. We're in the hyper growth phase for the stock, and so we feel really good about the scaling that we're doing. Yes, there are impacts of seasonality. Calendar Q4 tends to be heavier with holiday shopping, and as I shared in my remarks, we had a really strong holiday season, so there's a little bit of sequential impact there. And yes, the growth of interest-bearing will tend to create some back-endedness to both the revenue and margin profile of those originations. But again, I think we're very happy with the pace at which we're scaling, and we're certainly not focused on or concerned with the next quarter. We're really looking about where this network will be over the next decade.
And then, Michael, this is probably also for you, but and I think both of you and Max highlighted that there's been a lot of questions around interest rates, but a lot of the other questions have to do with delinquencies, et cetera, and as you said, is that you're kind of close to your target. But we noticed that the most recent update, at least in the supplemental, indicated that the percentage of 30-day delinquencies started to turn down and away from kind of your 2% target in recent weeks. Is that purely because of the nature of the incremental mix from the likes of Amazon, or better consumer repayments, or are you tightening the credit standards? And how should we expect that to evolve in coming quarters?
Yeah, very good question. If you look at the chart that we have in the supplement, you can see the seasonality curve of delinquencies. There's actually quite a bit of seasonality tied to both the shopping seasons and the repayment schedules that happen, and we're back to a more normalized seasonality curve with respect to what you see in delinquencies. And to reiterate the point, I mean, we're very happy with the credit outcomes we're driving right now. We take a very intentional approach here, and we have intentionally been loosening the credit box over the past year. We're still below 19 and 20 numbers, fiscal 19 and 20, and feel really good about the level of delinquency in light of the total unit economics that we're driving. And the only other thing I'd add is that we really do manage to a total portfolio number here. There's a bit of a misunderstanding, we think, out there with folks looking at not the portfolio delinquencies, but looking at one securitization vehicle or one particular slice of our business. We are very thoughtful about portfolio construction that goes into any one of our funding vehicles, and each one has a unique profile based upon market demand and our needs. For example, the split pay content may change. We may pledge loans that have some starting delinquency, et cetera. And so no one securitization data set can really represent the portfolio, and would really encourage everybody to look at our investor supplement to see a real view of portfolio-wide DQs.
That's great, Michael. Thank you very much.
Our next question comes from the line of Timothy Chiodo with Credit Suisse. Please proceed with your question.
Great. Thanks for taking the question. Michael, you touched on this a little bit in your prepared remarks in terms of slide 13, which has the merchant fee rates. And you're right, overall, most of the lines are pretty stable. I wanted to see if we could just touch on a few of them that are moving around a little bit. Specifically, the dark blue, which is the split pay, seems to be ticking up a little bit in terms of the take rate. I was thinking maybe that could be related to Shopify. Also, the purple line, which is the core IB, just ticking down a hair, maybe related to Amazon. And then if you could help us maybe elaborate on either of those, and also the green, the non-integrated virtual card, I'd really appreciate that context.
Yeah, the last we have the least amount of control over. That really is a function of the network interchange that we earn. And I think you nailed it. The line that you see on split pay merchant fee rates up versus Q1, we were promotional with Shopify in particular in Q1, but really up even year on year back to the fiscal Q2 in 21. So we feel really good about our resiliency with respect to the most competitive space, which is the split pay product set. The IB line that you point out is a function of the growth that we have in our largest enterprises, where we would earn less there than we would everywhere else. And part of the reason we're so confident in how we're growing is those two things mix in our favor, where you've got a lot of growth in the split pay offering with really high merchant fees, and you have a lot of user growth that comes along with that, combined with these enterprise scale offerings that will drive tremendous processing volume, as well as, in the long run, we think really strong economics. So feel really good about the mix. I really want investors to understand that when you have this sort of major shifts in the mix in the portfolio, it will shake out differently in the income statement.
Thank you. Point well taken there on the various mix dynamics. Appreciate it. Quick follow-up is on processing costs. So fully appreciate that the Shopify revenue share will hit in that line item, which could cause a little bit of upward pressure on that specific expense line. But a potential offset could be reduced card mix within their loan repayment. Is there any potential for you to work with someone like a Plaid or a Finicity to help increase the mix of direct bank account repayment?
Yes, there is a potential. I was just starting to fall asleep because you guys are asking Michael excellent questions, and he's doing a great job of answering them. Sorry. The long and short of it is, it's exactly right. The way I think, and this goes back many years now, the way we look at our transactional economics is across multiple dimensions. One is, of course, lifetime value of the consumer, kind of managing credit side of it. But if you, in the ROA basis, you have to look at the charge-offs that you incur. And once Michael touched on this really well, and it's kind of all over my script, but basically we manage that to a number. We decide what that's going to be, and we drive that to a basis point that we like per product, per merchant, et cetera. After you're done with that, you look at your other costs. And servicing is the one where we're always really hesitant to mess too much because you want the consumer experience to be amazing. And obviously over time we'll optimize that to a perfect number, but the sort of the high-touch white glove service that we've created is really, really valuable to us. We're completely ruthless on the rest of it. The repayment cost is something that just screams, take these basis points away. And you're totally right. There's lots and lots of opportunity. The repayment devices or vehicles are not all created equal. There's some really interesting innovation happening even sort of beyond ACH, which is